Want help to grow your business? Download BRiN, the world's first business advisor in your pocket. To find out more, visit BRiN.ai or search the App Store today.
Hello and welcome to Empire Builders. Now, leveraging and compounding is often talked about as being the eighth wonder of the world and an essential part of property investing. So how do our lending institutions work and how can we make the best of our situation? Well, joining me today on the show is John Flavell, CEO of Mortgage Choice. Good to see you, John. Thanks for joining us.
Thanks for having me, Chris.
So I guess a lot of kids these days saying, it's so tough these days, but what is lending and borrowing kind of like these days compared to maybe 20 or 30 years ago when our parents were doing it?
Yeah, or even, when people like me were borrowing for the first time, Chris, some 25 years ago. So I think of the choices that I had then. And I ended up going directly to the bank that I'd been banking with as a young child, cap in hand as it were, and I was eventually given an appointment to speak to somebody that told me that this is the property that I'd be, this is the product rather that I'd be getting, and this is how much I'd get, and that's the interest rate that I'd pay, and I'd get given it when the time suited. So, that was my entree to borrowing 25 years ago, and of course that was really much around the time that just post deregulation of banking in Australia, the broking industry was just getting off the ground, and you look today and it's a case of being able to go out there, have a broker come to you at a time that suits you, and be able to speak to you about your needs and getting your needs met, and being able to then go and work across a panel of 25 or 30 lenders, hundreds, maybe thousands of different loan options, and get you the solution that you want and the time that you want on your terms. So it's quite a different game now than it was back then.
Look, I got my first bank loan maybe 24, 25 years ago, and my dad took me down to see the bank manager.
Yeah.
I then went for a mortgage a few years later, and again, it was direct to the bank, and mortgage brokers weren't really heard of, or you'd pay them money to go and do it, whereas obviously now they're pretty free.
Very different.
So I thought we'd start off by talking some basics at the moment of kind of borrowing for a home and get some of the first home buyers kind of in there. In terms of some of the basics, quite often they say LVR or loan to value ratio.
Sure.
What are those basic terms meaning?
Yeah, sure. So, loan to valuation ratio is a good place to start. So, imagine that I'm purchasing a $100,000 property. I've got to come up with some sort of deposit. I've got a $25,000 deposit. I borrow $75,000. So my loan to valuation ratio is therefore 75%. And so it goes. And so, it's a bit of a daunting prospect, isn't it? Sort of working out how to make the savings over an extended period of time to build a bigger deposit. And so, asking the question, how much can I borrow and how much more quickly can I get into the market is certainly front of mind for a lot of people.
Because generally when the banks are assessing you, it's basically on two things. It's really what's your deposit and also what's your serviceability. So they want to see your income and see how stable you are and probably how much you've been saving as well.
Absolutely. And so I think, if you look at it to the point that you made, it's what is my income? What's the nature of the work that I do? Is it full-time? Is it part-time? Is it casual? Is it a base wage? Is it dependent on bonuses and sales commissions? So what's the strength of the income? What's the industry that I'm in? And then what are my outgoings? What are my existing commitments? And then looking at my track record as a borrower and saying, well, where I've had loans before, maybe a personal loan or a credit card or something such as that, have I performed? Have I paid my debts on time? And putting all those things into consideration as well as the amount of deposit that I bring to the purchase is what a lending institution looks at, yes.
Now, you mentioned brokers quite often look at maybe 30 or 40 lenders, and we've got lots of people all around the world, and there's lots of different institutions there as well. Do they all look at things exactly the same way, or are there kind of right banks or lending institutions for a particular type of people?
Sure. I think, look, it is a global financial system, and it's more ubiquitous in terms of the approach that lenders take, and we have international banking standards and lending institutions that are operating in one region. You look at Singapore or Hong Kong or Asia, well, we've got the same lending institutions operating there as you do in the UK. So there's global brands and global businesses. The approach that they take and the fundamentals to lending are very much the same, yeah.
Now, another big question for people, quite often for homes, they say, right, you need a principal and interest repayment, so you're going to pay off the home versus just going interest only. Can you explain the difference and maybe which way should people head?
Sure. So principal and interest versus interest only. So go back to that $100,000 property. Let's assume that I've borrowed the entire amount and I'm paying 4.8% interest. And on an interest-only basis, then my payments would be $400 a month. At the end of the year, my loan amount would be $100,000. It finished where it started. Whereas principal and interest, then my monthly repayments might be, say, $500 a month, and at the end of the year, my loan balance might be, $98,500, same interest rate. So you'd say, well, that's good. Paying your loan off is good. And first principle, yes, but typically housing finance or mortgage finance, the interest that you pay on a home loan is typically the lowest rate of interest that you'll receive on any form of debt.
Because basically they see it as a good risk, don't they?
Yeah, it's about what's the price for risk that the lending institution takes. And what I always say to people is, look, you've probably got motor car loans, you might have credit card loans, you have a raft of different loans, and the rates of interest that you might pay on a credit card unsecured lending are going to be a whole lot more typically than they would on a mortgage. So why not go interest only on a mortgage, take that additional cash flow, pay down those higher rates of interest loans, your credit cards and your personal loans, and then when you've done that, then divert that additional cash to amortising the home loan. There's also, I suppose, different tax treatments as well in relation to interest payments on your home loan versus interest payments you might be making on an investment property. And so I think the first thing is, eradicate the high interest rates on debts, then look at what's tax effective in terms of, interest that I can get a deduction against as opposed to not. But yeah, eradicate the high interest rates, then amortise your home loan, pay that debt down, and you leave your lower priced, tax effective interest loans to last.
And I guess you've got to look to see what kind of a person you are as well, because my dad was always an advocate of when I got a car loan, he said, no, don't go for a loan and they'll charge you a fortune, you're better off going for an overdraft. But then the banks are arguing no, because an 18-year-old with a car loan and an overdraft, they're never going to pay it back because they're going to go and blow their money. So sometimes the principal and interest, it can be that forced saving can be a great thing.
It can, and I think you're dead right. On a spreadsheet, most things work very, very elegantly, but then in practice they're quite different. And so knowing yourself and being realistic with yourself, there's nothing like ensuring you save or forcing you to save. There's nothing quite like forced savings. And if you've got a principal repayment as part of your monthly commitments, then you do know that you're going to amortise that debt, and it's not up to you to do the right thing and to actually divert discretionary cash into amortising your debt. So you're dead right. Know yourself as well as your spreadsheet.
Now, for a lot of young people these days, they can afford to travel the world. They've got phones, computers. Again, it's a changing kind of world. A lot of people don't want to get into property when they're young. They don't want to be tied down to it, and they think it's going to be a ball and chain. Whereas sometimes the people that have started early have started to realise that, look, at least you're building an asset, and then suddenly, otherwise you are going to blow all your cash, suddenly you start at 20, and by 30, you've suddenly got a nice little nest egg that you can really leverage to do something else.
Absolutely. Well, I mean, you talked in the introduction about, the power of compound interest, and I think Einstein said that the most powerful force in the universe was compound interest, and he came up with the theory of relativity, so there might be actually something in that. And of course, compounding interest, the longer the period, then the more powerful it becomes. And so if you assume that I'm buying an asset and that asset's going to appreciate in value over a period of time and compounding, the earlier you get in, then of course the better positioned you are going to be. And then, people turn around and they say, oh, look, I've left it too late, I've missed the boat. And I remember 15 years ago, and you probably did as well, friends that said, this is silly, property's too expensive, I've missed the boat, I'm not going to bother. Well, that property's probably maybe worth 3 or 4 times as much now. and it didn't
Exactly.
get any cheaper.
Because everyone's saying property is expensive.
Yeah.
But they've never said it's cheap, have they?
No.
They've never said residential. And look, obviously there's some crashes in the GFC and the US and the rest of it. But apart from that, virtually no one has said property is cheap. It's always been expensive.
Yep.
But what our parents thought is expensive is different to us, and our kids are going to have a different feeling.
I think you're right. And I think the other thing too is the time horizon. So, everybody would like to buy an asset, to hold it for a very short period of time and make a wonderful capital gain. And if you look at property or any class of asset like that, then it's speculation. The shortest time frame that I can think of for an investment like that would be $100, at Happy Valley Racecourse on a short price favourite. You'll find out very quickly one way or the other. But with property, if you take a long-term view, and I do take a long-term view of property, if you buy well-located property where you can have good, solid rental demand, if you can expect that the environment that you're in is going to have, consistent inflation over an extended period of time that leads to wages growth, that, supply is not going to choke the market, then you've got an asset that over the long term will perform very, very well. And take that long-term view of real estate and start early to the point that you made, and I believe, and I certainly have been well served by it.
So certainly for the first home buyers over there that haven't yet entered the market, property can be a great way to start your wealth creation. And for some of you business owners out there as well, you'll have realised that your family home could actually be the chance to actually leverage to actually grow your business as well. So whether you're in business or an employee, it can be a great start to a financial future. Now join us after the break as we take it another step further and then take a look more at the institutional side of lending for investors. Join us after the break. Welcome back to Empire Builders. Today we're talking to John Flavell, CEO of Mortgage Choice, trying to get an idea of how we can enter the market and how investors can get more sophisticated advice around lending. So we've had a quick chat about first home buyers, and now I want to move on to investors. Now for some people, actually buying your first investment may be a better option than actually buying your home, because suddenly you get tax deductibility in a lot of countries.
Absolutely. And, funny you should say that, Chris, because a lot of people have come to that same conclusion in local markets over this last period of time. And, in markets that people see where they might like to live as being a little bit unattainable as they're starting their careers out and so forth, it makes a sense to get a hold in that market, maybe, buy something that you otherwise couldn't afford to live in today, use it as an investment for a period of time, and then move in yourself. And we see a lot of people doing that. But what we also see is people that made those sorts of plans for themselves, 5 and even 10 years ago, and they actually end up never moving into those properties. They retain those properties and they kind of leapfrog them and they go off onto the next one because they built some equity up and they're away. So it's a popular strategy for the reasons you talked about.
It's very true, because most people can't afford, no matter what income they're on, they can't afford to live in the suburbs that they want.
Yeah.
And so again, the whole philosophy is buy when you can afford to buy, and buy it in the best possible place to get that capital growth or the rental yield, and then just choose where you want to live. If business is good, go and get a great property.
Absolutely.
If business is a bit tough, you can suddenly change straight away. Whereas when you've got that home, you can't suddenly downsize. Or if you're in that GFC, you can't suddenly move out when everyone else is trying to sell.
Yeah, absolutely. No, you're dead right. And I think that, more and more people are alive to that and looking at it as, I need somewhere to live, but where I live and where I invest don't need to be the same places, and young people are alive to it.
Whereas they call the Great Australian Dream the home, they say the same in the UK. I think countries like Germany, most of them rent there, they don't buy. And you get a lot of expats in Hong Kong, Singapore and other countries around Asia. They're used to the renting. And so
To continue enjoying this presentation, download BRiN, the world's first business advisor in your pocket. To find out more, visit BRiN.ai or search the App Store today.